Is this bank after the Q earnings still a buy or it's time to sell? And with that, hello and welcome back to Investing for Generations, your channel for high quality stock research for long-term value investors. And since the earnings season is on the way, today Scotiabank just published their Q3 earnings of their fiscal year. And I will go through this with you and will explain what I think about these numbers. As you maybe know, if you follow me already, Scotiabank is the biggest position in my portfolio. And so, of course, I have a big interest in the numbers. And so I looked at it a little bit closer. Just here up in the corner, you find my total analysis of Bank of Nova Scotia or Scotiabank, where I explain why I think this is a great long-term investment. So check this out. And of course, also you find on the playlist on my channel a video to all of my companies in my portfolio with a deeper analysis. So also enjoy that. And if you're not already subscribed, just do and hit the subscribe button and also the like button if you like the video. So Scotiabank published today the Q3 earnings. The Bank of Nova Scotia boosted its provision credit losses even higher in the quarter ended July 31st, 2020 than it did in the previous quarter as a coronavirus-induced recession threatens credit quality. So the provision for credit losses of 2.18 billion Canadian dollar increased from 1.85 billion in fiscal Q2 and 713 million in fiscal Q3 of 2019, so year over year. So this is, of course, a big increase, almost triple their provision for credit losses. The provision on impaired loans was 928 million Canadian dollar versus 776 million a year ago. And the EPS was at $1.04 versus a consensus of $1.11, so a little bit under the consensus, but not so much. The return on equity was at 8.3%, which is a little bit higher than in the previous quarter, but very much under the 14.3% a year ago. And the net interest income was at 4.25 billion versus 4.42 billion in Q2 and 4.37 in Q3 2019. So just keep that in mind that the net interest income in Q3 2020 was almost the same like in 2019. What we see, of course, is a big decrease of the EPS. Almost all of that just come from the higher provision for credit losses. We just have to understand what are provisions for credit losses. And per Investopedia, provision for credit losses is an estimation of potential losses. So we don't have real losses, we just have potential losses, just like a safety net for Bank of Nova Scotia or even other big banks. Also JP Morgan did that and put a lot of provision of credit losses in the estimation. Provision for credit losses are expenses on the company's financial statements. And so as they count as losses, of course, their earnings per share drop and their earnings overall, and then their earnings per share just drop. So of course we have a decrease of the earnings, but just because there are provision for credit losses. And of course you can highly expect that the credits right now are more in high risk because of the pandemic situation and the recession and maybe depression looming. And of course, maybe the banks have to write off a lot of the credits and a lot of these credits will not pay back. And so they build a safety net. But who knows, maybe it will be not that worse as they estimated now. So we will see in the coming quarters. If you think about that they build so much of these provision for credit losses, and still make money and still are profitable, very high profits, even with this high provisions. I think overall, this just shows me how stable this business is. Of course, at the first look, the decrease of the earnings per share is negative, but on the second look, when you see at the provision for credit losses, and hopefully they don't need all of that, it just looks not that worse anymore. And first of all, it just shows me what solid business we have here. And with this said, the question with the Bank of Nova Scotia, with a lot of other banks which pay a high dividend, becomes, is a dividend safe? With all I said before, for me the dividend is safe, and also in the past, Bank of Nova Scotia, or better Scotiabank, is a very safe dividend payer. The dividend increases in 43 of the last 45 years, and they pay a dividend since July 1st of 1833. I think the dividend is safe. Maybe we will not see a big increase like we saw in the past, but I think we don't have to wonder about the dividend overall, and that's nice and that's good, even more for the long term. There's almost no reaction on the market also today. Bank of Nova Scotia lose 0.74% right now. So there's not a high reaction the one or the other way. So I think this is highly expected. Nothing to wonder and nothing to change, I think, in the big picture. So I will still just hold my position. Of course, if it drop again to maybe under 40 or even better 35, I will add even more. I think this is a really, really solid basic investment. So what's my conclusion overall with these numbers of Scotiabank? As I said, for me, it's still a hold for the long term. There's no reason to sell even with these numbers. Of course, there are difficult times for the banks with the low interest rates on the one side and the economic problems right now and even in the foreseen future, and the uncertain pandemic situation too. But in the long run, I think Scotiabank is still a great investment, plus a very good and safe dividend. So I'm very happy with this investment. And with this said, just take the weekly look into my portfolio and just start with the dividend I got this week. And this week I got my dividend of Caterpillar of $10.10. Not much, but at least something. And the dividends will just grow over time, and so there's will be a nice cash flow over time. And then take a look also at the performance of all my single stocks, and of course Facebook is one of the few tech stocks in my portfolio just fly and is 55% up right now. But also the other companies are almost high in the plus and perform really good. And also Bank of Nova Scotia right now is 11% in the green, and that's fine. You can't expect from big companies like that they outperform the market by far, even not in the bull run we have right now. But you can expect a solid, stable return. If a company like Bank of Nova Scotia make a return of 8 to 10% per year over the long run, I'm very happy. And I think this is how you have to look at it if you are a long-term value investor. And then also take a look at the performance compared to the S&P 500. As you maybe already know, I started this North American portfolio at the 2nd of December 2019, and since then my portfolio has a performance of 24% and outperformed the S&P 500 by a little bit over 14% right now. And this is really nice, and even nicer when you think about that there are not so many tech stocks which drive the bull run right now in my portfolio. So I'm very happy about that. I also build up a little bit more cash, and so I will be also prepared if we will have a correction or crash anywhere soon. But really, I mean, nobody can really predict the market. You just can be prepared for every situation, and right now I think I am, and that's a good feeling. So that's it for today. If you like the video, give me a big thumbs up. If you're not already subscribed, subscribe to my channel to never miss another video and ring the notification bell, of course. And then we will see the next time, and then with another analysis of another stock out of my watch list. See you then. Take care. Bye bye.